Now.
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 No.
Now.
Now. Now. Now.
It's
It's
your
time.
your time.
My time. My time.
Your time.
My time.
Your time. Your time.
My time.
Now
it's your
time.
Hi dear future investors, back again with me Dinda at the ENMOY Corporation channel. Today we're going to talk about a pretty straightforward book published and written back in 2007 by the Mohnish Pabrai called the Dhandho Investor. So long story short, this book lays out a pretty powerful framework about value investing. So it will be very impactful for us to understand investing, to invest smartly and effectively after we watch this video. So without further ado, let's dig into a deeper discussion with our group at the classroom.
Thank you, Dinda. Well, we'll see you again on the end of the video, Dinda. And right now, we're so ready to talk about the Dhandho Investor. Have you guys read about the book?
Yes, of course.
Yes, of
That
course.
was really good.
It was an interesting book, and actually, we also got a lot of reflection. Before and after reading the book, there are a lot of knowledge gained to us, right guys?
Yes.
And how about it, Fidi? What that should take from this? From me, I think this is really an important message. One is that we can also invest in low risk and in a high return.
Okay, that was a really good book, I mean, like, when I first time to read this book, I mean, like, it's kind of like, it's too good to be true, When you see something like, when you can, maybe when we choose some coin, like, for example, like head and tail, you may lose something. But in this book, when you choose head, and then after that you get tail, and then it's not both lose actually, you still get winner, but there's something, maybe a little tricky from this book, so that's why it made me interesting about this book. So maybe we would like to dive into this book, right?
Okay.
For example, like when they say about focus on buying existing business, actually, for me, there's so many public companies, when you want to doing something, when you want to put your money, actually, for example, like Andaru, you want to marry, actually, and how you put your money, so it's and then how we choose the company. And the first thing, when I know I want to buy some company that make me interesting. For example, like there's a big company already IPO or something like that. Maybe for the first time for me as a dummy investor, actually, I thought that wow, it's a good investment. But for this book, they said that you should choose a company that already published and existed maybe, and already have a long term or maybe have a long experiences as a public company. So it makes me change my mind actually. So and there's so many frameworks, like right?
So by saying that a long-lasting company is the best investment, right?
Yeah.
So as Warren Buffett said, change is the enemy of investment. So what we should talk about before we invest to a company is whether or not the company will last long, and whether or not it is proven to have existed for a long time and have stable income. So whether or not the company will exist in 50 years or 100 years. So that's one of the principles in Dhandho's book, actually, that we should buy simple business in industries with slow rate of change.
Simplicity is key.
Yes, exactly. So for example, like let's say energy is a very in topic right now, right? And or
like renewable energy.
Yes. Yes, especially after G20, right? So that's one of the key industry that we could invest on. And
We agree with that.
Yeah.
so, Andaru, what do you think about the next Dhandho principle in the book?
Dhandho's principle that he ever mentioned about buying a distressed business in the distressed industry. So, Fidi, maybe you can tell me about what you have told me several years ago in the case.
Yeah, actually, as we know that maybe there's some cases in several years ago, they would be say like FOMO, like
Fear of missing out.
yeah. For example, like there's something certain people that maybe spreading of information regarding the stock, so everyone want to buy that stock. Okay, but after that, you know what happened? It's flop. It's going down. It's going crash. So what it needs to become a big event actually, because there's so many investors that didn't know actually what kind of investment, what kind of company, what is that company actually. They only just put the money. And for example, as we know that we should put the what we say like bulk money or in our savings, but they put the
Primary money, their
primary
own
money.
salary.
Yes, of course. So that's why when it's flop, they lose all money.
Okay, so in that book,
It's dangerous.
Yeah, of course.
So in that book, you're saying that be fearful when the others are greedy and be greedy when the others are guilty.
Yeah, that's right.
So I have quite tips for not to be found in that case, and one of it is to analyze more before investing, because as Warren Buffett says that risk comes for not knowing what you are doing.
Yeah.
That's what that was the principle of risk management.
Always know what your steps.
And there's a couple of tips that I learned from that book. That in that case that you said before, that we know that the instrumental pump is some kind of artificial strategy, and there's a couple of tips of that. One thing is we have to know what are the costs of this upward movement, because it was so freaking fast. We don't know what the cost is, so learn about the fundamental aspects. We know, and we also have to know what the backstories of the upward movement is, and we also have to analyze about the current performance. We have to analyze about the future expectation of the company, what are they doing in that sectors of the industry. And then, but things to keep in mind that the expectation that we are going to use about what are the instruments that we are about to invest is, we have to remember that expectation is always a 50-50 ratio, because in the real life, but one thing that I really what I get from that book is, even that the expectation is not doesn't come so well for us, we still know that we are being responsible for our action. Yeah. So that it could be a lesson for us too, and it could be a lesson for the future investment. That's right.
Yeah. Okay.
See big picture actually.
The big picture. Actually, it's also very important as just a distress business or maybe an existing company, but also we have to bet on a company with a very high, durable, competitiveness.
Yes.
Yeah, because there's a lot of company out there with their own competitors, and also the company with their own original brand value. Actually, the one that is very sustainable and also provide a superiority compared to like other competitors. Like they don't need to compete among others the same business. Like
Yes.
If let's say another business competes in their own campaign, they sell a very low price to their products and their campaign and so on. that makes the investor actually very unsatisfied and take out their money, and it's very not safe for us all, a dummy investor, right?
True.
So that's the one thing, guys. You have to choose one company that is very secure, that they don't need to go on give a low price. As long as they live with it, they can survive without competing with other investors. Actually, they're very secure about their own performance, their own business, and their own brand.
Yes, that's a good point.
So you're talking about the bricks on foundation.
Yeah.
So that's why there's some kind of keywords also from the Indo. They said that we should focus on arbitrage actually. So
Arbitrage.
Yeah, arbitrage is a situation in which there is a free about profit in the market after transaction cost. So it's meant like this is Dhandho on exercise actually. It's for example like if you choose its head, you win, and when you choose tail, maybe you just go break even or maybe still win. So that's the point. So maybe it's not uncommon statement actually, but it's still possible. Maybe later we will discuss about this. But this is a good interesting point actually for me about how we manage the investment. We gambling, like you say, that it's 50-50 and we even don't know about what happened next year, maybe tomorrow or something like that. But how to make sure my money is still set in the company. So it's good things, I mean, like for this in this book.
Yes, and regarding to what Fidi just said earlier, it's also one of the principles in Dhandho's book that we should bet heavily when the odds are overwhelmingly in our favor. So, as we all know, the stock market is, efficient, but it can only stay efficient for, so big. So, I don't know. I just want to say that even though we should not be afraid to go big when the opportunity comes, we should also just, go big when the right time is upon us. Just don't take risks when it's not the time to. So
the momentum.
Yes, the momentum
Save
is
for the moment.
very important.
But also we have to
Yes.
take challenge.
Yes.
Take the big numbers.
Yeah.
Choose big, dream big.
Yes.
Yes.
And then there's also time that you should just sit still and
Sit
just
still.
ride the wave.
Don't be panic.
Yes, don't panic. Just stay on your track with, the opportunities that will come to you in the time.
With your recent portfolio, no matter how bad it is.
That's from our portfolio actually.
That's from our portfolio.
Yeah, actually, because we started reading this book after we started our project, right?
That's the first mistake.
Yes, our first mistake is not reading
we
this
should
book.
read this book before
Yes.
we started investing
Exactly.
project, guys.
2,000 years later.
So welcome back to
ENMOY Corp! Okay,
Did you guys miss us? Oh, not yet. Alright, so
One eternity later.
okay, the other things that I've learned about the Dhandho's instrument is about buying business with a big discount but with a great underlying value. So I'll explain you about more. For the example is if we are oftenly buy some bar of chocolate in the supermarket, we know that the average price of the chocolate is about 10,000 rupiah, and there's coming a big discount, like it's about the Valentine's Day, maybe chocolate price maybe will go down to half the price, maybe just 5,000 rupiah, and then you're surely gonna buy it, right?
yes, of
It's
course.
gonna be quite cheap. Yeah, but it is the same. But in the stocks market, there's no sign of a big growth of these stocks. The stocks A or B is only great promotion, so you
There's
can
no
buy.
9.9.
Yeah.
There's many.
12.12.
No,
There's no
No, we never know.
So how could we know?
for tip, so we always use a calculation to seek about the price to book value. So you can know that is it something on the higher price, or you can it's on big discount. So you can buy and invest more expectation with the high profit and the outcomes for the future.
Let's just talking about the profit and discount, guys. There's also a very interesting value actually from this book, which is we have to seek for a low risk and high uncertainty. We also have to look for the low risk and high uncertainty. Like we always want a very certain business. We want a certain number. We want a certain profit and also gain something very certain. But why the Dhandho's recommends us to seek for a high uncertainty? Well, actually, it's to avoid the large. Actually, it's for avoiding the large permanent loss, guys. Well, like we have to see the risk and the uncertainty. There are different aspects actually, and the investment can have a wide range of possible future outcomes. And therefore, the risk of taking a large permanent loss investing in such opportunity may be still very low.
Yeah, so just for tip to add to Gina's what is mentioned, we know that certainty is really important aspects even in the relationship.
Oh. Why?
It's coming from personal experience.
So that's why it's going to marry.
Oh yeah.
Congratulations! Thank you.
Well, in some relationship we also seek for uncertainty.
Yes.
Like we want that fire, that drama,
And
we
flavor,
need
yes.
that flavor,
Yes.
that taste, and yeah, we're just the dummy investor.
Okay, that's a good point actually. I mean, like the last framework or framework from the Dhandho investment is called copycat. I mean, like for the past, I mean, like we would like to do some
Invest
research, invest something, research by ourselves, but you know, say that you can do copycat actually. For example, like if you already see the company that are already proving that they are going to profit something
Their
like that.
strategy.
Yes, of course, we can do a copycat actually. Well, we should do ourselves the research actually. For me, if I do some research, maybe it's
Right.
for example, like 50-50, it's good or not. So that's why it's good for a copycat. That's the key you must give for.
It's okay to be a copycat
Yes, of
in
course.
this arena.
Yeah.
Yes.
Do you guys know in Indonesia we call there's another abbreviation of ATM, that the automatic teller machine, amati biru modifikasi.
Amati biru modifikasi.
That's a good one.
Yeah. Research, imitate, modify.
Yes. You know, like, so after we talk about all these principles, the thing that I take away from this is that investing is all about the odds, right? It's all about the timing, it's all about the opportunity, it's all about the uncertainty, of course, right? Yes. So like
Gaining and losing.
yes, exactly. So like, imagine that you have like $25 and that you're asked to place a bet on a coin flip, like you said. With, you know, like there's obviously a 50-50 chance, right? So there's an added probabilities, such as like, for example, if you win heads, the probability is like 60%,
Okay.
not 50,
Yeah.
60%.
Yeah.
So like the odds are like, if you want to take heads, then you have to double the bet. So it's not 25, it's 50.
Oh.
And if you choose tails, the probability is lower, it's 40%, but the payout would be losing all of it, your bet, right? So how much would you be willing to wager of your total 25 on this coin flip? So like, this is like one of the examples. So it's not always fair chance. There's always an underlying quality that we may not know, and there's like surprise elements, let's say, right? So it's all about the odds. Like if we already have all the information needed to perform the investment, and the odds are in your favor, you should absolutely do it. But if the risk is high, maybe you should just sit still and just wait it out.
It's okay to sit still.
It's
right?
okay to sit still, yeah.
Guys, go big or go home.
Yeah.
But
Sit one
inside.
part. Sit one part.
Yes.
That's from our friends.
Okay. Okay. And that's a very promising and valuable lessons, guys.
Yeah.
Right? But actually there are more. There are more formula.
Yes.
There are more technical and financial tactics.
Yeah.
And I think we're going to see more from it from our friend Dinda.
Bye, Dinda.
Thank you, Dinda.
So thank you, group, for the discussion. Next up, we also have another important notice from the book called the Kelly formula, as seen down here. So this formula is used to determine your optimal size of the investment. So it will be based on the probability and also the expected value of win or loss. And next up, we also have the prominent one called the DCF analysis. DCF analysis is used to value your security, project, company, or even an asset using the time value of money concept. So now we're moving on nearly to the finish line, so hang on in there. Now we have the art of selling, or should we say the exit plan. So making an investment is only half of the battle. We also need a good strategy to sell. At Dhandho Investor, we'll try to sell when the market price exceeds the intrinsic value. So that's all about the important frameworks and financial theories from the book. But lastly, please remember to never sell your stock at loss. Please share, like, comment, and subscribe to this channel for further videos to become an amazing, brilliant investor. I'll see you on the next video. Bye-bye!